Integrating AI into financial services exposes a structural paradox. Decision-making patterns that work at human scale become systemic liabilities at machine scale. A human credit analyst makes approximately 300 decisions a year. A machine learning model can execute 300,000 decisions in that same timeframe. At human scale, inconsistency is the primary risk. At machine scale, the danger is mechanical consistency. If a model's training data contains a historical bias, the system reproduces that bias with absolute precision across every decision it makes. AI outputs in a financial institution are legally regulated acts. Every credit denial, claim rejection, or product recommendation carries the full weight of the organization's legal and supervisory obligations. Biased training data scales legal risk with mechanical precision. A single flawed pattern in the dataset translates into thousands of individual violations of anti-discrimination law. Because AI scales decision-making infinitely, any architectural flaw in the model results in a catastrophic class-action level compliance failure. Institutions face three simultaneous mandates: APRA's focus on AI cyber resilience, OSTRAC's expanding AML and CTF regime, and Privacy Act amendments governing automated decision-making. ASIC has designated governance failure as its primary enforcement focus for 2026. The most critical regulatory shift, however, comes from the Financial Accountability Regime, or FAR. FAR shifts the consequences of AI governance failure from corporate fines to personal liability. The regime establishes personal, non-delegable responsibility for named executives if the AI systems they own violate financial services laws. For CTOs, CIOs, and CROs, relying on paper policies or fragmented accountability across different departments is now legally unsustainable. Properly designed governance architecture makes innovation sustainable. It creates the legal buffer necessary to protect executives from personal liability while scaling AI capabilities. Defensible AI must be hard-coded into the engineering pipeline. It cannot be retrofitted after a model is already deployed. Moving a model from proof of concept to production requires an unbiasable model registry gate in the CI/CD pipeline. This gate triggers automated bias testing using frameworks like AI 360 to evaluate fairness metrics before authorization. This process satisfies the explainability imperative. SHAP values decompose complex model predictions, allowing a specific credit denial to be precisely explained to a regulator. An immutable, worm-compliant audit repository sits beneath this entire pipeline. This repository permanently captures every training run, bias report, and deployment approval, in a format that cannot be altered or deleted. Engineering governance directly into the pipeline produces examiner-ready documentation at zero marginal cost per decision. We manage operational friction through a formal risk-tiering sorting mechanism. Tier 1 systems, such as credit approval or insurance underwriting models, directly influence regulated consumer decisions and require full independent validation. Tier 3 systems are internal tools, like code generation models, which operate under significantly lighter governance requirements. Even with defined tiers, institutions face the speed trap. Business pressure leads teams to bypass established gates. The model drift blind spot creates a separate risk. Models are validated only against population data from deployment day. Over 18 months, macroeconomic shifts and changing customer strategies alter that base population. A model validated as fair at deployment can drift into producing discriminatory outputs as the environment changes. Pre-production processes are only effective if paired with a continuous 4-stream monitoring system to detect this drift in real time. Why are AI systems still failing in institutions that have already built these CI/CD gates and risk tiers? Consider a scenario where a technical bias alert flashes red, but the business executive who legally owns that model cannot interpret a disparate impact ratio. Personnel who cannot operate a governance framework effectively reduce that framework to mere paperwork. This is the enablement gap. Traditional structures fail when they assume staff automatically understand how to operate complex MISC architecture. True enablement requires the continuous translation of governance requirements into the specific daily language of each team's workflow. This means compliance officers must be trained to read algorithmic bias reports, and developers must understand exactly which parameters trigger a gate failure. Under FAR, accountable persons must demonstrate a working knowledge of their AI governance obligations before they are questioned by a regulator. Governance and enablement must be engineered together. Building the infrastructure without equipping the humans to operate it creates a massive, latent liability. The ultimate test of an institution's AI architecture is the 4-hour audit. Producing a complete, immutable audit package within hours of an APRA or ASIC request signals a highly controlled environment. This speed acts as a critical de-escalation tool, preventing a routine inquiry from escalating into a deep-dive investigation. The cost of failure is documented. In the TD Bank AML case, unmonitored automated systems resulted in multi-billion-dollar penalties because gaps were left unaddressed for years. These multi-billion-dollar settlements dwarf the actual cost of continuous monitoring, which requires a few $100s a month in compute time. The mathematics of compliance are clear. The cost of proper governance is a rounding error compared to the cost of a regulatory failure. Beyond risk mitigation, there is a measurable trust dividend. Institutions that govern AI effectively capture outsized economic value. This value is evident in the Commonwealth Bank reducing customer scam losses by 76% through governed AI, and global banks safely deploying enterprise LLMs to hundreds of thousands of employees. For technology leaders, the 90-day action plan starts with a complete, attested inventory of every AI system in production. Next, risk tier every model and officially designate the FAR accountable executives for all Tier 1 systems. Finally, build the enablement track parallel to the technology. Train your teams on the specific checklists and escalation protocols required to keep the governance gates functional. Governance provides the architecture for scaling AI safely. Without the enablement to operate that architecture, institutions simply build a faster route to liability.